Linda is 64, lives outside Raleigh, North Carolina, and worked 31 years as a hospital billing supervisor before retiring at 62. She does not consider herself careless with money. In the spring of 2021, her father passed away at age 78. He left her a traditional IRA worth $420,000. The custodian set up the inherited IRA in her name and told her something that sounded exactly right. The IRS had waived the annual distribution requirement for 2021 and 2022 and 2023 and 2024. Linda breathed out. She did not need the money yet. She would deal with it later. Her father had been taking required minimum distributions before he died. She did not know that one fact mattered. Nobody explained it to her. She took nothing in 2025. She has taken nothing so far in 2026. She's now sitting on an inherited IRA that grew to $480,000, 2 missed distributions the IRS has already stopped waiving, and a 25% excise tax on every dollar she was supposed to withdraw and did not. Linda did not break a single law on purpose. She followed what her custodian told her. The waivers were real, the waivers ended, and now the clock she thought was paused has been running the entire time. And she is not alone. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Kevin Retires. Every week I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button and turn on notifications so you never miss a video. If you inherited an IRA from a parent, a sibling, or anyone who passed away after December 31st, 2019, this video is for you. This is the single most misunderstood change in retirement tax law of the last 5 years. The custodians got it wrong. Most accountants got it wrong until the regulations were finalized, and hundreds of thousands of beneficiaries are about to discover they are behind on distributions they did not know they owed. A 25% penalty on a missed distribution from a $400,000 inherited account is not a parking ticket. It is assessed quietly against a retiree who never received a letter, never got a call from the custodian, and had no idea the rule even applied. Today, I'm going to walk you through exactly what changed on July 19th, 2024, when the IRS finalized the 10-year rule in Treasury Decision 10001, who owes annual distributions right now and who does not, how the 25% penalty is actually calculated in dollars, and the one form you file before December 31st of this year that can reduce that penalty down to 10%, and in many cases, all the way to zero. This is not theoretical. The waiver period that covered 2021 through 2024 is over. The enforcement window is open. If you inherited a retirement account in the last 5 years, there's a specific question you need to answer this week, and the answer decides whether you owe the IRS a 5-figure penalty or not. Before I keep going, here is what I could not fit into this video. There are 3 specific scenarios I walk through step by step in the full retirement tax research. 3 worked examples that most inheritors never see, because they require the kind of year-by-year calculation that does not work in video form. The first is the complete 10-year distribution schedule for a non-spouse beneficiary, age 62, who inherited a $400,000 traditional IRA in 2021 from a parent who had already started required minimum distributions, with every single life expectancy factor from publication 590B, every annual withdrawal, and the total federal tax paid across all 10 years compared to draining the account in year 10. The second is the Form 5329 Part 9 walkthrough for the missed 2025 distribution, showing exactly where to enter the reasonable cause code, what the waiver letter needs to contain, and the documentation retirees have used to get the 25% penalty waived entirely. The third is the inherited Roth IRA versus inherited traditional IRA comparison over the full 10 years, showing when it makes sense to drain the Roth in year 10 for maximum tax-free growth versus spreading the traditional across years 1 through 9 to manage bracket creep with the state tax impact in the top 10 retirement destinations. All 3 are in the retirement tax research. The link is in the description, first link right at the top. If you inherited an IRA after 2019 and you're not certain whether you owe a distribution this year, that documentation is where the full numbers live. Let me get back to it. Here's what the law actually says. The Secure Act was signed into law on December 20th, 2019. For account owners who died on or after January 1st, 2020, Congress eliminated what was called the Stretch IRA for most non-spouse beneficiaries. Before that change, an adult child who inherited a parent's IRA could take small distributions over their own life expectancy, sometimes 30 or 40 years. After that change, most non-spouse beneficiaries have 10 years to empty the account, every dollar, out of the tax-deferred shelter into your taxable income. That is the 10-year rule. And then the IRS spent 4 years arguing with itself about one specific question. Do you have to take an annual distribution inside those 10 years? Or can you just wait and drain the whole thing in year 10? If this video is helping you see something that was invisible to you before today, something your custodian or your accountant has never explained this clearly, hit the like button right now. It tells YouTube to show this to more retirees and adult children who need to see it. And if you haven't subscribed yet, do it now and turn on the bell. This is the kind of content you want in your notifications. Now let me keep going. The answer was finalized in Treasury Decision 10001 on July 19th, 2024. And the answer is, it depends on one fact: whether the person you inherited from had started their own required minimum distributions before they died. The required beginning date is the date an IRA owner has to start taking their own required minimum distributions. For most people, that is age 73 under current law. The question is not just how old the person was. The question is whether they had actually started taking distributions or were legally required to start before the year they passed away. Here is the line. If the deceased account owner died on or after their required beginning date, a non-spouse beneficiary who is subject to the 10-year rule must take an annual distribution in years 1 through 9 and empty the remaining balance by the end of year 10. If the deceased account owner died before their required beginning date, a non-spouse beneficiary subject to the 10-year rule does not have to take an annual distribution. They can wait and drain the entire account in year 10. Same 10-year deadline. Completely different annual obligation. For a $400,000 inherited IRA, the difference between those two scenarios is a penalty exposure of roughly $30,000 or more across the decade if you are in the first category and do not realize it. Now, the waivers. Between 2021 and 2024, the IRS issued a series of notices that waived the 25% excise tax for beneficiaries who did not take annual distributions during those years while the rules were being finalized. The waivers were real, they were official, and they are now expired. Starting with the 2025 tax year, the annual distribution requirement is fully in force. Missing it triggers the penalty. And here is the part that catches almost everyone. The waiver period did not pause the 10-year clock. If you inherited in 2020, the account still has to be fully distributed by December 31st, 2030. If you inherited in 2021, the deadline is December 31st, 2031. If you inherited in 2022, it is December 31st, 2032. The waivers gave you breathing room on the annual requirement. They did not give you breathing room on the final deadline. Every year you did not take a distribution while the waivers were active is a year you now have to compress the full distribution into a shorter remaining window. There are exceptions, and they are narrow. The 10-year rule does not apply to what the IRS calls eligible designated beneficiaries. That category includes a surviving spouse, a minor child of the account owner until they reach the age of majority, a beneficiary who is disabled or chronically ill under the specific IRS definitions, and a beneficiary who is not more than 10 years younger than the person who died. Those beneficiaries can still stretch distributions over their own life expectancy. For everyone else who is a designated beneficiary, the vast majority of adult children inheriting from a parent, the 10-year rule applies. For trusts and estates as beneficiaries, the rules are different again and almost always require a tax professional to work through. Here is what this looks like in two real situations. Take Patricia. She is 61, lives in Ohio, and inherited a $300,000 traditional IRA from her mother in 2022. Her mother was 79 years old when she died, past her required beginning date and taking required minimum distributions for years. That single fact puts Patricia squarely in the annual distribution category. She was supposed to take a distribution in 2023, 2024, 2025, and 2026. The IRS waived the first two. She still owes 2025 and 2026. Each of those distributions, using the single life expectancy table, is roughly $12,000 given her age. 25% of the missed 2025 distribution is roughly $3,000. That is the penalty floor if she does nothing. Now take Kenneth. He is 61, lives in the same zip code, and inherited the same $300,000 traditional IRA in the same year, 2022. But Kenneth's father died at age 68 before the required beginning date. No annual distribution is required during the 10-year window. Kenneth does not owe a distribution in 2025. He does not owe one in 2026. He just has to have the entire account emptied by December 31st, 2032. Same age, same state, same account balance, same year of death, completely different obligation. The only variable that changed is the age of the person they inherited from. And almost nobody on the beneficiary side knows this is how the law works. Now here's the fix, and this is the part you need to understand before December 31st of this year. If you missed a distribution, you are not locked into the 25% penalty. You have a correction window. Under the Secure 2.0 Act, If you take the missed distribution and file Form 5329 by the end of the second tax year after the year the distribution was missed, the penalty drops from 25% to 10%. And if you include a reasonable cause statement with that form, the IRS has discretion to waive the entire penalty down to zero. They do that routinely when the miss was honest and you have corrected the problem. The mechanic is specific. You download Form 5329 for the tax year the distribution was missed. You go to Part 9, the section called Additional Tax on Excess Accumulation. You fill in what the distribution should have been. You fill in what you actually took, which may be zero. The difference is your shortfall. On the dotted line next to the entry for the excise tax, you write the letters RC for reasonable cause, followed by the amount you're asking to be waived in parentheses. On the line for the actual tax owed, you enter zero. You attach a written statement, 1 page, explaining why the distribution was missed, what you have done to correct it, and the steps you have taken to make sure it does not happen again. You sign it, you mail it in, or you file it with your return for that year, and then you wait. In most reasonable cause cases, the IRS never writes back. That is how you know they accepted the waiver. If they disagree, you will get a notice in the mail. But the default outcome for an honest first-time miss is a full waiver. Here is your action checklist. 9 steps starting this week. Step 1, pull out the death certificate and confirm exactly what year the person you inherited from died and exactly how old they were at the time. Step 2, confirm whether they had started required minimum distributions. You can call the custodian of their IRA and ask, or check Form 5498 filings on their account. If they were age 73 or older in a tax year before they died, they almost certainly had started. Step 3, identify which category you are in. Non-spouse designated beneficiary, eligible designated beneficiary, or trust. For most viewers of this channel, it will be non-spouse designated beneficiary. Step 4, calculate your 10-year deadline. If the person died in 2020, your deadline is December 31st, 2030. If they died in 2021, it is 2031. Mark that date on your calendar right now. Step 5. If you owe annual distributions, calculate the 2026 required minimum using Table 1, the Single Life Expectancy Table, from IRS Publication 590B. You use your age in the year after the owner's death to establish your initial factor, then subtract 1 for each subsequent year. Your custodian can run this calculation for you. Step 6. Take the 2026 distribution before December 31st of this year if you have not already. Do not wait. Most custodians go into heavy end-of-year backlog in the last 2 weeks of December, and distributions can get stuck in processing. Step 7. If you missed the 2025 distribution, take it now. Same year, same calendar. Then download the 2025 Form 5329 and file it with your federal return or as a standalone. Step 8. If you are filing a waiver request, write the reasonable cause letter. Keep it short. State the facts. Do not argue. Do not apologize excessively. Describe the error, the correction, and the safeguards you are putting in place. Step 9. Talk to a qualified tax professional who has specifically updated their approach for the 2024 final regulations. Not every accountant has. The rules are new enough that the industry is still catching up, and you need someone who can confirm your category, your deadline, and your distribution schedule before you sign anything you file with the IRS. This is not a situation where you wait and see what the IRS does. The IRS receives a Form 5498 every year from every custodian, reporting the account balance. They know exactly what the required distribution should have been. They know whether you took it. The systems paused during the waiver period are turning back on for tax year 2025 returns. Notices start going out through 2026 and 2027. The difference between a retiree who caught the problem and filed the waiver and a retiree who waited for the IRS to notice is often the full difference between a $10 stamp and a $10,000 penalty that never goes away. Drop a comment and tell me, did you inherit an IRA from a parent or sibling who passed away after 2019? And did anyone ever explain this 10-year rule to you properly? I read every single one, and the most common situations become future videos on this channel. Let me give you the full honesty here. This rule was not written to punish anyone. It was designed to close what Congress viewed as a generational tax shelter, the ability of wealthy families to stretch inherited IRAs over 40 and 50 years of tax-deferred growth. That policy choice is defensible. What is not defensible is the communication gap between the regulation finalization in 2024 and the beneficiaries, who are now on the hook in 2025 and 2026. Most custodians told their account holders about the waivers. Almost none of them called back to say the waivers ended. Now you know. And knowing this week before the calendar closes on another tax year is the entire difference between a clean filing and a 5-figure assessment. This is Kevin Retires. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to hear it. If you're not subscribed yet, hit subscribe and turn on the bell so you don't miss the next one. And if you know someone who inherited a retirement account in the last 5 years, send them this video today. The difference between knowing this rule and not knowing it can easily be more than $10,000 over the 10-year window. And for larger inherited accounts, it is many multiples of that. I'll see you in the next one.